Dear learners, welcome back to another video on ratio analysis. I am Listener Juice, and in this video we will see creditors turnover ratio and working capital turnover ratio in detail. How debtors or receivables will arise in a company? Yes, if a firm selling goods on credit, what happen? These debtors will arise in a company. Then how creditors will arise in a company? Yes, if a firm purchase goods on credit, what happen? These creditors will arise in a company. And we know that in debtors turnover ratio, we will take net credit annual sales into consideration. Right? Then coming to creditors turnover ratio, what we will take into consideration? We will take net credit annual purchase. Right? Then in debtors turnover ratio, we know that we will take average trade debtors as denominator. And when it comes to creditors turnover ratio, what we will take? We will take into consideration average trade creditors. And we know that debtors will form a part of current asset. At the same time, these creditors will form a part of current liability. And now we can see how we can calculate this creditors turnover ratio. This ratio can be calculated by dividing net credit annual purchase by average trade creditors. And how we can calculate this average trade creditors? We just need to add opening trade creditors plus closing trade creditors by 2. Then this trade creditors includes sundry creditors and bills payable. Then how we can calculate this net credit annual purchase? When we deduct cash purchase and purchase return from the total purchase, we will get the figure of net credit annual purchase. Suppose if information about credit purchase is not available, then the figure of total purchase will be taken as numerator, and if opening and closing balance of creditors are not known, then the balance of creditors given will be taken as the denominator. Now we will see how we can interpret this creditors turnover ratio. This ratio indicates, that means creditors turnover ratio indicates the velocity or speed. The velocity or speed with which creditors are turned over in relation to purchase. So higher the creditors velocity or higher the creditors turnover ratio, better is the performance, or otherwise lower the creditors velocity or creditors turnover ratio, less favorable is the performance or liquidity. Now we will see another concept in creditors turnover ratio, that is average payment period. So this average payment period ratio represents the average number of days taken by the firm to pay its creditors. So generally, lower the ratio, better is the liquidity position of the firm, and higher the ratio, less liquid is the position of the firm. But sometimes higher payment period may be because we know that higher payment period shows the less liquidity position of a company. But sometimes this higher payment period may be because of greater credit period enjoyed by the firm. Suppose a firm is very trustworthy one, then automatically what happen? that firm will get more credit facilities or they will get a more credit period. So that might be the reason why it shows the high payment period ratio. Then this high payment period may be also because of lesser discount facility offered to them, or maybe they have purchased goods on higher price. So while interpreting this average payment period, one should take an extra care. Okay, I hope it is clear to you. Now we will see how we can work out a simple problem. Here total purchase is given as 4 lakh. Then cash purchase is 50,000. Then there is purchase return, that is 20,000. Then creditors at the end, that is 60,000. Bills payable is 20,000. Reserves for discount on creditors 5,000. Then we need to take 365 days in a year. And you are going to calculate creditors turnover ratio and average payment period. So shall we start? Okay. First we will calculate what? Creditors turnover ratio. And what is the equation for calculating this creditors turnover ratio? It is net credit or net annual purchase, net credit annual purchase divided by average creditors, right? Then how we can calculate this net credit annual purchase? We know that from total purchase we need to deduct two things. What are they? We need to deduct the cash purchase as well as if there is any purchase return, we need to deduct that also. Purchase return. So here total purchase is given as 4 lakh and cash purchase is mentioned here is 50,000 and there is a purchase return also, that is 20,000. So what is the figure of net credit annual purchase? It is 3,30,000, right? And now we need to calculate this average trade creditors, right? And we know that the trade creditors includes both creditors as well as bills payable, right? And here there is no opening and closing balance of creditors. It is given only creditors at the end. So we just take that creditors at the end, that is 60,000, and there is another figure is given bills payable. So we need to take that also because trade creditors includes both creditors as well as bills payable. So what is the total figure? It is 80,000, right? So now we can calculate creditors turnover ratio, that is 3,30,000 divided by 80,000, right? Then what is the answer? It is 4.13 times, right? And now we can calculate average payment period. And what is the equation for calculating this average payment period? We know that days in year divided by creditors turnover ratio, and the question it is given as 365 days, so we just take that, and creditors turnover ratio is 4.13. Then what is the final answer? It is approximately 88 days. Okay. And now we will see the last ratio comes under turnover, ratio, that is working capital turnover ratio. So this working capital turnover ratio indicates the velocity of utilizing the net working capital. And also it will indicate, that means this working capital turnover ratio indicates the number of times working capital is turned over in a year. Then how we can interpret this working capital turnover ratio? Higher the ratio, it shows the efficient utilization of working capital, and lower the working capital turnover ratio, it indicates the inefficient utilization of working capital. And how we can calculate this working capital? Working capital means the capital that is required to meet the day-to-day activities or day-to-day operations of a company. So the excess of current asset over current liability, that will give the figure of working capital. So current asset minus current liability, you will get the figure of working capital. And working capital turnover ratio can be calculated by dividing cost of sales by average working capital. And how we can calculate this average working capital? Opening working capital plus closing working capital divided by 2. Suppose if the figure of cost of sale is not given, then we will take the figure of sales instead of this cost of sales. And on the other hand, if the opening working capital is not disclosed or not mentioned, then we will take working capital at the end as the denominator. Right? And now we can work out a simple problem. Here cash is 10,000, bills receivable is 5,000, sundry debtors is 25,000, stock is 20,000, sundry creditors is 30,000, then cost of sale is given as 1,50,000, and you need to calculate this working capital turnover ratio. And what is the equation for calculating working capital turnover ratio? We know that it is cost of sales divided by net working capital. Right? And we know what is cost of sales. It is already given in the question, that is 1,50,000. But we need to calculate this net working capital, right? Then how can we calculate this net working capital? Net working capital means we need to deduct current asset minus current liability. That will give the figure of net working capital. So first of all, what we need to do? We need to calculate this current asset, right? Then here current asset includes what? Cash will be included, that is 10,000. Then bills receivable, that is 5,000. Then sundry debtors is 25,000. And stock is 20,000. So what is the total figure? It will give all about 60,000, right? Okay. Then current liability, there is only one item here, that is 30,000. So current liability is 30,000. So what about the working capital of a company? We need to deduct 60,000 minus 30,000. That means 30,000 is the net working capital. So now we can put these figures in the equation. Cost of sale, that is 1,50,000 divided by net working capital is 30,000. So 1 lakh divided by 30,000, that means 5. That is 5 times the working capital will be turned over. So this is all about working capital turnover ratio. So for this about 3 videos we were discussing about turnover ratio. I hope the concept is clear to you. We will see you in the next video. Till then, keep learning. Thank you.